Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review with the emphasis on the difference between what I call rich people problems and non-rich people problems. Because you could still make a lot of money and still be broke, but non-rich people problems doesn't sound as good, so I have to call it poor people problems, unfortunately. So we're going to talk about the differences between rich people problems and poor people problems. Now, I know there are some of you out there on YouTube land who understand the difference because I just got this comment yesterday. Rich people problems are better than poor people problems, and that's exactly what I want to talk about. That's exactly what I want to talk about today. You know what the difference between rich people problems and poor people problems are? Okay, I'll tell you the biggest difference is, can you go to sleep at night? I remember when I used to make $20,000 a year, I could not go to sleep at night. Like I was just like, ugh, like how am I gonna make it? You know what I mean? And rich people problems is like, ugh, this is so annoying, but I can go to sleep. Okay? That's the biggest difference. Like when you have poor people problems, it's like, am I gonna make it after the end of the month? And then rich people problems are like, oh no, I submitted a business credit card application and I got rejected because the creditor said I have too much credit. That's like rich people problems, right? Okay. So we're going to talk about the difference between that today with the emphasis, or we're going to emphasize that today and also talk about velocity banking. And here's another rich people problem, right? So you know how everyone's like in the rat race and you just kind of like stay at home and chill and you're like, man, I got too much free time and too much money. Oh, well, I gotta, exercise my mind and make these YouTube videos. And that's why I'm easily able to make like 700 YouTube videos in a year talking about the same thing over and over again, not because I need the money, but just because I need to exercise my mind. And that's why I make these videos over and over again, right? So, and just to kind of show you what doing a YouTube channel can do for you, let me just show you here before I actually get into the velocity banking subject. I don't have that many views. I got 21,000 views in the last 28 days, and I made $333. In fact, my last October paycheck, I got at least about 400. Let me just show you right here. Yeah, $406 to do these videos over and over and over again. And I know some of you criticize this as like, well, you just talk about the same thing over and over again. And I'm like, yeah, you know why? Because it's low effort money. It literally is low effort money just to do a spreadsheet. So let's just go ahead and make myself a little bit more money today, even though I don't need the money because banks don't lend money to people who need it. I'll talk about that for today. But let's just do the same. Again, practice makes perfect. Let's just do the same velocity banking scenario as the last video. See, this is the problem with a lot of people. They're like, you talk about the same thing over and over and over again. And that's how you get good at anything. You want to get good at a language? Practice like the most basic of sentences, most basic of vocabulary over and over and over and over again, right? That's how you get good at anything. And you know what most people are like? Well, I attended a 3-day piano boot camp and I should be like the best at piano. That's how most people are, which is kind of sad. Like, and I'm like, bro, practice your craft. Practice it every single day when you can, just little by little. And when you have developed all the micro skills for success, then it's going to be like a really smooth symphony. Like, you ever notice that when I do these velocity banking videos, it's just really smooth how I just transition from one thing to another. And in fact, some of you are like, "You all go too fast." It's like, well, if I slow down, you know what's going to happen? These videos are going to be like 3 hours long, and I know that most of you don't have an attention span for that. So if you cannot keep up, just pause these videos. That's why pausing is great. Much better than the VHS days when you pause on a video and it ruined your video, or rewinding actually ruined your video. You can actually rewind here and no problem there. Okay. All right. So let's talk about this. So here, I don't know if I would call this like a poor person problem because we make good money, and that's why I like the classification of non-rich people versus rich people problems. But let me ask you this, okay? If you made $8,611.68 and you made your expenses with $8,600 $8,611 $611.67. Do you think you could sleep at night with 1 penny left over in savings? And if the answer is yes, then you're in rich people problem land. If the answer is no, you're in poor people problem. So even though this person makes good money, poor people problems, right? I remember clearly when I used to make 20 grand a year and I was just like, I can't take it anymore. I'm so stressed. And now it's just like, oh, plenty of free time. And, last problem I had was I applied for a credit card. I was like, too much credit. Okay, well, all right. So let's do this. Let's shift. We're gonna shift eventually by the end of this video from poor people problem land to rich people problem land. Okay, that's what we're going to do here. And so what we're going to assume is we have access to something called a line of credit. So if you take a look here, right, this is my home equity line of credit, and it's kind of like a credit card. It's like you apply to the bank and say, hey, Mr. or Mrs. Bank, and although I don't know if there's anybody in the bank where you say, hey, Mr. or Mrs. Bank, right? Or Miss Bank or whatever you want to call it, that I have a home. I have equity. Please, I'll put it as collateral. Please give me a credit card like thing called the line of credit so that I can use it as collateral, and then you give me a huge line of credit. That's what a home equity line of credit is. It's like a huge credit card based on what they call home equity, which is the value of your home or the estimated value of your home minus, okay, estimated value of your home minus all the debts that you have. And because I have absolutely no debt on my home, I have no debt anymore, no mortgage, because I paid it off for the 3 years. I was able to secure a $280,000 home equity line of credit. Okay, now that's the most unrealistic assumption about this demonstration that we're going to make, because if you're 1 penny left over and you try to get a home equity line of credit there, they're usually not going to give it to you. And the reason why, and this is how we have to understand credit, we have to understand how the bank's mindset is that banks don't lend money to people who need it. This is how I have over $527,000 in lines of credit, and I'm pretty sure within a couple of years it'll be $1 million if I'm strategic about it. But I have over $527,000, and the reason I have so much is because I know what the banks are looking for. If you are interviewing with a vampire to do business with a vampire, do you present yourself as, oh, I got the blood sucked out of me by all the other vampires, or do you think, hey, nobody has sucked my blood and I'm really fresh, right? Which one do you think the bank is looking for if the bank were a vampire? Wink, wink. The person who has all their blood sucked out by all the other vampires, or the one who's full of fresh blood? You got to understand that it's not a bad thing to present yourself as someone that they can make money off of, right? Like, I'll just like, dude, I got plenty of income, and look at this. I don't need money, and therefore the banks are willing to give me credit. That's just how they work. And so if you understand that mindset, it's not about like getting yourself out of this, even though that will really help people. In fact, people have emailed me like, I'm struggling, and I actually have a line of credit, and what happens is that their line of credit is maxed out. So they probably got that line of credit at a point way before they needed it, right? So what I'm saying is that yes, you can get yourself out of a jam, but most people, they think that they can actually get a line of credit because they don't understand how banks work. Banks are not restaurants, right? Like, you go to a restaurant because you're hungry. You don't go to a bank because you need money. That's not how they know that you're a huge risk when you're at a point that you need money, therefore they won't lend to you. Okay, you get that? So get it out of your mind. And again, it's like, how do you get car insurance after you crash your car? Okay, after you crash your car and you didn't have insurance. Maybe there's a way. I don't know, but I'm not going to teach it because I don't want to focus too much on that, right? So but let's assume that we do have a line of credit available, okay? Now, in order to velocity banking, there's really two things. So I talked about this. So number one is a budget. So we see that a budget is the first thing we need. And the second thing is a line of credit. So let's just assume we have access to a $150,000, 8% line of credit, okay? So as I've shown you here, it is possible to get that big of a line of credit just because home equity is very valuable. And banks, their ultimate goal, okay, is not to like foreclose on your home, right? That's the last thing they want to do. That's like their last, it's like their scare tactic, right? They'll do anything to not to foreclose. Okay, I don't know if you knew that or not. Their goal is to make sure that they can lend to you and you rack up a high balance and not pay it off. That's why whenever you apply for a home equity line of credit and you look at the bank's marketing, it's always about like making big purchases, like renovating your home, because renovating your home is not that cheap. If you spend like 80 grand on a home renovation, believe it or not, that's like a total house makeover. It's like full gut renovation. Okay, I don't know if you knew that, but they want you to spend that much and then just not pay it off. Sometimes they say go on vacation, you deserve it. Like you deserve it. Those are the three words that have ruined everybody's lives, right? Or a lot of people's lives. Okay, so enough ranting. All right, so here's the most important thing. You know how we have this penny of savings left over? We're going to put this to zero, right? And this is the part that scares so many people. This is it. This is like, I can't do this because I was trained that I need 3 to 6 months of savings. I mean, if you take a look at mainstream personal finance advice, Dave Ramsey and the seven baby steps, the first baby step is save $1,000. And I'm telling you, hey, like, we don't need to save $1,000. In fact, when we're in our debt payoff journey, we're never going to do this. Okay. We only saved $1,000 once our debt is completely paid off. Okay. So let me just kind of go here. Okay. So now I'm going to take my expenses, copy them over to the velocity banking section, and then just going to do C2 minus C3 when we're at something called cash flow. Okay. Now, this cash flow is not savings. I want to tell you that because when you have savings, and you get your checking or savings account statement at the end of the month, it's not going to be zero for the average person. But when you're doing velocity banking, right? Beginning balance is zero, ending balance is zero, which is it's a foreign concept to most people. They're like, what? Like, why would you not have savings? Because our money is either going to be one of two things, right? It's going to be actively applied to debt, actively applied to debt. All of it is going to go to debt. And if we need it, we take it from the line of credit at the necessary moments, right? Or number two, we spend it on investing, right? I am not a super investment guru. I can't give you advice on that. Again, I do real estate, right? I do real estate, but even then, I still feel like a noob. But I feel like I'm a noob that got $500,000 of equity in like less than 2 years or 3 years. I don't even know, right? Less than 2 years, we'll say. Or no, 3 years. Okay, 3 years. $500,000 of equity in less than 3 years. Now I know people are like, life insurance is the best thing. I used to sell life insurance, folks. I don't know how you get $500,000 in a life insurance contract and cash value in under 3 years, because in year seven, that's when that's when things start to go well. So I'm just like, kind of like, oh man, like real estate's probably better than life insurance. But again, I'm just rambling on. Okay, so let me go back here, and we're going to assume we have access to a home equity line of credit. Now, this cash flow, we want it to increase by moving some of our debt into the line of credit, moving some of it. So the easiest debt that you can move is the credit cards and the short-term loans, like those buy now, pay later Affirm loans. And in fact, I don't know if you ever did a Google search, like those loan companies, like they make it seem like so easy. Oh, it's just buy now, pay later, and it's free. Somebody had sent me a copy of their like contract or their loan agreement, and I'm pretty sure that person didn't understand what they're going into, because the buy now, pay laters were like 30% interest, and every time I go to the website, I always see zero, so I'm like confused, right? But if you just do a Google search like Affirm, right? Annual, no, let's say annual revenue, $2.3 billion. Now, I know revenue is not profit, but $2.3 billion of revenue is still pretty good. I want $2.3 billion of revenue, you know what I'm saying? And that's how you know a lot of people are struggling, because if they're at the checkout counter of a website, and they're like, what do? I really want the product and I don't have any cash flow, then they ruin their cash flow by taking out another loan, right? Why are loans harmful? Like, I mean, loans can be good, right? I'm not saying don't ever take out a loan, unlike some other velocity banking people. But loans are harmful because they ruin your cash flow because they're one-way streets. Even though they might be lower interest, although I have seen 30% interest short-term loans, I'm not going to lie. And so these short-term loans and these credit cards, we just try to move all of that into the line of credit, okay? And so if you take a look here, $137,000 of credit card debt if you sum it up. So if we just do a balance transfer, essentially, transfer the balance, okay? Guess what happens to these credit cards? It's 0, 0, 0, 0, 0, 0, 0, right? Whoops, we don't want to do the auto loan yet, okay? So now we turned a penny into $4,450.84. And then if we take a look here, this 8,600, we dump it into the line of credit, right? Your entire paycheck goes into the line of credit. So essentially this would just be an overpayment, right? Anytime money comes in, line of credit, it goes in, right? That's all we do. And then it goes, balance is zero, and you just rinse and repeat the process over and over again. So paycheck in, expenses out, rinse and repeat over and over again, and then your cash flow will decrease, okay, the balance after every single month, right? So let's go ahead and do this. All right, and then now what we're going to do is do this. All right, and then so what is this formula? Basically, to get the next month's balance, it's the previous month's balance plus the previous month's interest minus our cash flow. So 4450.84, okay? And then what you do is you take the average daily balance. So let me go ahead and do that here. I'm going to take the average of these two numbers, multiply it by the interest rate, which is 0.08, okay? And you're not going to pay 10 grand of interest a month because that 0.08 represents the annual interest, okay? And then you divide by 12 because the interest is calculated monthly. So you're not paying 10 grand, but you're paying a little bit less than 1,000, but that's not that bad because you borrowed 130 something thousand dollars, right? So all we gotta do is copy and paste, and then once this goes to negative, then that's when we what's it called? Go big, or that's when we celebrate, right? And so, ah, my mouse is wonky today, but it's okay. Okay. Control C, and then Control V, and then we see that in 35 months, we are completely debt free. So 35 months. No, we're not completely debt free. That's a lie. But we paid off $137,000 of debt. Okay. And then now we have the auto loan and the mortgage. Okay. So let's take a look at this loan calculator right here. We have the auto loan and the mortgage. And what we do is we put in the current month, which is 35. So 35, 35, right? And we see, okay, what the current balance is. This is the latest balance after 35 months. So if we pay off this $9,000 of cash, or I'm sorry, $9,000 balance, we get this $396 of cash flow, right? That's a good deal. So let's just go ahead and put that in to our line of credit. So I'm going to do this, and I'm going to paste the value here, and then we're going to add plus 9187.66, okay? And we see, oh, wow, that's amazing. That's amazing. That's a spicy meatball. I didn't even increase the cash flow, and it paid off in 2 months. That's amazing. Okay, so now what we're going to do is increase our cash flow and put 0 here. And our new cash flow is 4846.87. So let's go ahead and update our cash flow. And we're going to do that. I'm going to copy, paste, and then we're going to just do this. 4846.87. Okay. And then now in 37 months, we paid off the, well, it's too easy, right? In 2 months, we paid off the car loan. So 37 months. And then let me just do this. So this is 157K. Okay. Actually, I just realized this is probably not the one we did last time because we probably did something else last time with a few more debts, but it's okay. And then now we have the mortgage. So at this stage, you're like, man, I could just either pay off the mortgage or just invest in rental properties. Now, I'll tell you what, I decided that it's actually better for me, okay, to invest in real estate. And then ironically, I paid off my personal mortgage first. It was okay. So here's the thing, right? The best financial decision isn't necessarily the best credit decision. Okay. So even though it would have made more financial sense to pay off my investment mortgage first, I actually paid off my own personal home first just because, what's it called? I could get a much easier home equity line of credit much easier on my own personal home than let's say a rental property. But at this stage, you decide, do you want to pay off your mortgage or do you want a rental property? And I probably needed to make another video on this about the whole rental property thing because I know a lot of you are interested. Um, I'm going to tell you my strategy. I don't want too many rental properties. I want like only like a couple. You know what I mean? I don't want like 100 single family homes. That's just too, especially, single family homes, believe it or not, are not easily scalable. They're not because, it's unlikely you're going to have 10, 20 homes in the same place unless that's what you're going to do. And a lot of people fall into the trap that if they invest out of state, that somehow it's going to be easier rather than understanding, hey, these are the market conditions for that market and this is how I make money, right? It might be easier just to do one home in California where you don't even rent it out and you just sit on it and then sell it, like buy it for like, I don't know, 200,000 like 1990 and then somehow sell it for like 1 million like 20, 30 years later, you know what I mean? Okay. So, let's go ahead and focus on the mortgage. So, let me just go back here and this is 37, okay? And so we see that we paid about 20 grand of the mortgage in about 37 months. Now, let's see what happens at this stage if we just simply move 20 grand into that line of credit. Now, we have not increased our cash flow just by moving 20 grand into the line of credit, but let's just take a look. 1, 2, 3, 4, how long it takes to eliminate that 20 grand, and look at that interest cost. It's relatively low, right? So it's 1, 2, 3, 4. So it literally took us about 4 months, okay? About 4 months to do something that the bank wants you to do in 37. And the reason why it takes so long to eliminate just 20 grand is because they want that sweet, sweet interest, right? That's the way that they make their money. Even at a 3% interest rate, okay, 3% interest rate over 30 years is 50% interest. Look at that, 155,000. Okay, so just be aware of that. All right, so just be aware of that. Now, this is what we call chunking, and this is not. So here's what people get wrong about velocity banking: that it's about paying off your mortgage. You have to think of it as a holistic strategy. And I talked about this in another video that the most neglected part about velocity banking in other YouTuber videos that I've seen is the emphasis on debt payoff order, right? So you got to know how to pay off debt quickly, and then if you want to eliminate the mortgage, then if you could do two things. Number one, direct extra payments, but nobody does direct extra payments. It's kind of like term life insurance or buying a membership at the gym at the beginning of the year. Yeah, you can pay, you can do it, but and it might even be cheaper, but nobody's going to do it. So what we're going to do is we're going to almost do the same thing but with the help of a line of credit so that we can apply all of our debt into the line of credit and freely move that money out so we don't segregate our income. Okay? So if you ever do the math, the interest calculated is pretty much identical. So that's why I don't do like super comparisons like, well, if you use a line of credit to pay off a mortgage, it's so much superior than doing a direct what's it called, extra payment. Nothing like that, right? Like I'm not going to say that. But what I'm going to say is that it's a strategy that when you're at this point and your mortgage is your last loan left, it will help you actually pay it off quicker because you're actually going to do it, unlike the first option, right? So let me go ahead and pull out the velocity banking calculator right here. So give me one moment. Whoa, take a look at that, right? Take a look at that. This is so crazy. I just plugged it into this velocity banking calculator by Renatus, and yeah, 4.1 years. And I'm so blown away. I really am blown away just how quickly I were able to pay this off in the simulations, right? 4.1 years. And you know what's even crazier? I'm gonna tell you what's even crazier. I paid mine off under 3. I paid mine off under 2 years and 9 months. This one right here. This is my paid off mortgage statement online, July 29, 2024. It's paid. Boom. Easy, right? And so if we take a look here, 4.1 years, I'm like, all right, well, sometimes if I do this too much and I'm like, I kind of get out of touch because like, I know that the average American can't pay a 30-year mortgage in 30 years. And so when I did mine in under 3, and then I see 4.1, I'm like, that's a little bit too high. No, I'm just kidding. I'm that's like a rich people problem, just being out of touch, right? So let's go ahead and write this down. 4.1 years, 18 grand. Now, you might have seen this on the internet. I'm just going to briefly mention it. I need to make a whole video about this, okay? So let me just do this, and I'm going to copy and paste this, just current balance, okay? 56 grand of interest versus 18 grand. Which one do you want, right? So this whole thing about our first lien HELOC is kind of a lie in my opinion, because if you do a first lien HELOC and there's an interest rate difference, this is the time when the interest rate does matter. Okay? Like this is when the interest rate does matter. But okay, this one, if you do small amounts, what we call chunking, you're going to save a lot of interest. All right. So this is going to be, let me just kind of do this right here. So 18 grand. Um, I'm sorry, where'd it go? Okay. So let's just go here. And this is like now 4.1 years. 4.1 divided by 12 plus 37. So that's actually, no, that's not right. So it should be, I'm trying to get the number of years. 4.1, 37 divided by 12. Okay. 7.18 years we're debt free. Again, this isn't 7.18 years mortgage free, it's 7.18 years debt free. Okay, debt free. And then now this is 0, and then now we're going to have the rich people problem that you didn't think was possible, which is that now you're just going to have an overflow of savings. And I don't know if you knew this or not about rich people, but rich people don't like to have savings accounts. Okay, like when you have all your debt paid off and you just have savings, like let's say $100,000 savings, and it's doing nothing, you're like, I'm a little bit nervous because now my buying power is eroding because of inflation, right? So you're looking for maybe a good real estate deal for 10 to 12% of your money. This is why I'm going to tell you this. It's much easier to raise money off of rich people than it is poor people. Because with poor people, it's like you have a lack of running water and you're trying to save that water as much as possible. That's actually a good strategy at that moment of your life. Okay, so I'm not dissing that. But what I'm saying is that when you have an abundance of water in your water tank and it just stays there and it's not moving, what happens to water that's just sitting there? It becomes stale, it becomes murky, it becomes yucky. You know what I mean? That's how rich people feel about money in a savings account, right? I'm going to tell you a story. I literally met a person first day, Korean guy, owned commercial properties in the 90s, since the 90s, had millions of dollars in his checking account. He literally showed me on the smartphone. Guy knows more than me because he's like talking about investing in Bitcoin and he made like 50 grand in Bitcoin. I have no idea how to even do that. Like I literally have no idea how to do that. So again, I know some of you are out there are like, well, it's because of my age and all this. That's BS because there are people who are older than me who are like more into these trends and know all this stuff. I'm just a guy who just does basic spreadsheets of math on YouTube. You know what I'm saying? But my point is this. I had never at that point met a man or a woman just offer me to loan me millions of dollars for a real estate deal on the first day, because I felt like I haven't met too many super duper rich people um, at that time, right? Like it was when I understand when I started to make more money and pay off my debt. Oh, that's why it's so easy to like raise money off of rich people problems, because you got too much water in your water tank and you want to make that water flow. You want to make that cash flow, right? Stale water, that's like savings accounts. hmm But if you're poor, and again, I'm not making fun of you if you're poor, but if you're not, let's say, not rich, and you have, it's a nice cushion to have some savings. But what I'm saying is this, okay? You're going to have a completely different mentality once you start to become rich, because you're like, savings accounts, why did I think that was valuable? You'll be like questioning everything, and then you'll be looking at like advice from Dave Ramsey, like this, even though Dave Ramsey is, I respect him. No, I'm not going to lie. He has 60 million in the bank, much more than I do. But my point is this: you'll be looking at baby step one with the savings of $1,000, and you'll be like scratching your head, like, why in the world did I think this was a good idea? That's the difference between rich people and poor people mentality, right? It's all in the mentality. A lot of it. In fact, I would just probably argue that money is just fake. You know what I mean? It's all like a confidence game. Like it's just fake because there's nothing to back it up. But I'm not an expert on that, to be honest, but I'm still the same person, believe it or not, when I was poor and when I was rich. Like money doesn't change you, it just amplifies who you are. And so if I was the same person, 10 years ago, the only difference between now and then, okay, is I got way too much free time on my hands, and now I got the free time just to make YouTube videos. And ironically, these YouTube videos make me more money, which is it's kind of bizarre that having money will just allow you the free time to make more money, if that makes sense. Okay, well, that's it for today. So now we are here. Okay, so when we start to have money in our savings account, now we're in rich people problem land, right? That's where we want to be. And it's a pretty sweet problem to have, because now, you can go to sleep at night. You know what I'm saying? Okay, well, that's it for today. So this is Korean Atlanta Mentorship. Have a great day, and we will speak next time.